students, welcome to the lecture series on international business. Today's discussion is on international finance and this is part 2. I am Professor Soma Sen Gupta, Kamala Nehru College, University of Delhi. In this lecture we will discuss, we will continue with FDI, the drawbacks of FDI, and specifically two types of FDI we will discuss, that is greenfield investment and brownfield investment. Now, when we talk about FDI, we have seen the advantages, how it is important for the development of the host country. But there are certain drawbacks, let us discuss them in detail. First is the risk to investors of FDI. FDI presents several significant risks and drawbacks for the investing company due to political and regulatory instability, currency volatility, exchange rate risk, cultural and social barriers, etc. Beside that, wars are happening between the country, which is also detrimental to the investors, and there is a risk. Then secondly, there is increased competition. The primary drawback of FDI related to increased competition is the potential displacement or closure of local businesses that will enable them to compete well with the multinational corporations. Then profit repatriation also happens. Foreign firms often send their profits back to their home countries rather than reinvesting them in the host economy, which can result in a net outflow of capital and limit the host country's financial resources. So, certain countries they ensure that the central bank of the country monitors the movement. So, rather than directly repatriating the profits from that country to another, they are kept in an account, and the foreign company they have to buy certain things from the host country, and the account is settled like that. Then negative impact on exchange rates and trade deficits happen. Large inflows and outflows of foreign currency can influence exchange rates potentially to the detriment of the host country. FDI can also lead to increased imports contributing to trade deficits. Political risks also are there. Changes in host countries' political landscape such as new regulations, tax policies, even expropriation sometimes happens, that is the government seizes the assets of the foreign firm. So, that can also happen, and all these can create an unstable environment for investors and the local economy alike. Also there is a risk of exploitation. So, potential for exploitation is there of the host country's natural resources, as it will be more used, and the cheap labor force who will be overutilized, with foreign companies prioritizing profit over the welfare of local workers or environmental concern. Loss of sovereignty and control will always be there whenever there is foreign investment. It may influence the key domestic industries, natural resources, even government policy decisions, potentially impacting national interests and sovereignty. Over interdependence or economic dependence will be there. Heavy reliance on FDI can make a host nation's economy vulnerable to global economic downturns or the sudden withdrawal of investment, capital flight. That means capital flight may be taking place between from the host country to the investing country, which can lead to economic instability. Also, concentration of wealth is there in few hands. The economic benefits generated by FDI may not be distributed equally across the population. So, benefits are concentrated among the skilled workers, urban areas, local entrepreneurs who collaborate with the foreign entities or the MNCs, but it is not spread over everybody, or the benefit is not reaped by everyone. And there, while rural and marginalized communities may also be left behind, there is dominance of MNCs over local firms. This creates a dual economy. Hindrance to domestic investment may also take place, that is large, well-resourced multinational corporations can create intense competition that may force smaller local firms out of the business, thus hindering the growth of domestic industry. So, and also although we boast of job creation, but many a times there is limited job creation and skill transfer that may happen. And generally the foreign companies, they bring their own skilled labor. So, that is not beneficial for the host country. Now, moving further, let us discuss the main types of FDI, and later on we will take up other forms also. So, here we will discuss the greenfield and brownfield investment. So, beginning with the greenfield investment. In economics terms, a greenfield investment refers to a type of foreign direct investment where a company establishes operations in a foreign country. So, here mostly obviously it is an FDI, long term interest is there, but in greenfield investment a new company is established in the foreign country by the investor. In a greenfield investment, the company constructs new, and that is why we call it green facilities, sales office, manufacturing facility, etc., cross border from the ground up. Here a domestic investor establishes a totally new business on the foreign soil, new in the host country, maybe in the country where from the FDI is coming, there the business might not be new, but in a foreign land new business is established. According to the Bureau of Economic Analysis, a greenfield investment is a project where foreign investors establish a new business or expand an existing business on foreign soil. So, I have given you different definitions of greenfield investment. Now, if we have to understand it, so in this, it is a form of market entry. Greenfield is of course FDI, and it is a form of market entry where the investor opens his own new business in another country, and hence it is called from the ground up approach of foreign investment, because you are establishing a totally new business. This is commonly used when a company wants to achieve the highest degree of control over its foreign activities. So, if you invest in an existing firm in the host country, it is not greenfield investment. If you are opening totally new company in the host country, what will happen? You have full control over its activities. It can be compared to other foreign direct investments such as purchase of foreign securities or acquisition of majority stake in a foreign company in which the parent company exercises little to no control over daily business operations. Now, what are the goals and advantages of a greenfield investment? From the discussion we have come to know that when greenfield investment takes place, a new entity comes into picture in a host country. So, full control will be there. So, most of the points will be related to control only. So, the goals: to get a potential tax break or subsidies in establishing a greenfield investment, because when you are investing in a if foreign investment comes in our country and opens up a new business, then tax holidays, tax breaks, subsidies might be given to that company depending upon the type of the project. Also, to achieve a high level of control over business operations, as I said, greenfield, the most important goal is to achieve higher control over the operations of the new business. Also, it avoids intermediary costs because you are directly investing in the other country. So, there are certain advantages, and mostly, as I said, it is related to gaining control. So, high level of control over business operation is possible for the foreign investors. High level of quality control over the manufacturing and sale of products and or services is there. And why it is there? Because no intermediary or no other company is there. You are yourself setting up a business in the foreign country, so you have quality control as well. High control over brand image and staffing. So, brand image is not diluted because it is your own company. Also, you are recruiting people at your own terms, in your own terms. So, you do not have to abide by another company's decision. Also, economies of scale benefit will be there, and economies of scope can be achieved in terms of marketing, research and development and production. Also, you can bypass the trade restrictions if there are any in that country. Also, it creates jobs for the economy where greenfield investment is taking place. So, all these are advantages, but there are disadvantages as well, because when we are talking about opening up of a new company, then naturally different barriers may be there and the cost escalates. So, the disadvantage is an extremely high risk investment. A greenfield investment is riskiest from form of foreign direct investment, because you are opening a new company in a foreign land. Also, there is potentially high market entry cost, because every country has certain barriers. So, this also leads to barrier of entry for the greenfield investment. Government regulations that may hamper foreign direct investments. If a foreign company is investing in India, then they have to cross different barriers, and one of them is government regulation, which hampers the FDI. High fixed costs are involved in establishing a greenfield location, because you are starting from the ground. So, that will lead to a huge investment in the foreign land. Let us discuss greenfield investment with the help of an example. Suppose company A is based in Europe and is looking to expand its operation internationally. The company wants to penetrate to the US market with a new innovative product. So, the company is from Europe and it is entering in US market. Upon completing market research, company A realizes that there are few to no competitors in the United States. Thus, there are no acquisition opportunities available to the company to establish a base. So, what am I saying is that no existing company is there, so you cannot invest in that. So, obviously, you have to open a new company and then it becomes a greenfield investment. In addition, the United States previously imposed tariffs on all European imports, causing the selling price of the company's product to be very high when it comes to import product. So, if the European country not opening the firm in United States and starts exporting products to the United States, then they have to bear the problem of tariffs. But if you open a new company in US, that problem will not be there. So, company A decides to create a sales office and manufacturing facility on US soil with the goal of bypassing existing US import tariffs and also to penetrate into the domestic market with its new product. So, likewise, company A from Europe establishes a new business in USA. The company CEO deems establishing a foreign subsidiary crucial, as it will then be able to exert complete control over the overseas business operations and brand image. Now, if we take the real world examples of greenfield investment, one of them is Hyundai Motor Company in Noshowais. In 2006, Hyundai Motor Company received approval to make around 1 billion euros with a major greenfield investment in a city called Noshowais in Czech Republic. The automaker established a new manufacturing plant that employed up to 3,000 individuals in its first year of operation. The Czech government provided tax relief and subsidies to prompt the greenfield investment in hopes of boosting the country's economy and lowering the unemployment rate. So, you can see how this company is getting tax relief, subsidies, because it is investing in another country, also generating employment. Another example is of Toyota Motor Corp in Mexico. So, in 2015, Toyota Motor Corporation announced plans to establish a new manufacturing facility in Mexico through an investment of about $1 billion. Slated to open in 2019, the facility is expected to produce up to 2 lakh units per year in conjunction with the currently established Tijuana plant. The rationale behind Toyota's greenfield investment is to improve competitiveness in North America, specifically within the United States. The low labor cost and the close proximity to US markets offered the Japanese automaker an attractive opportunity to establish an overseas manufacturing facility. Now coming to the next one or type of FDI, that is the brownfield investment. Now it is different from greenfield investment because here you are investing in an existing company in a foreign country rather than establishing a new firm over there. In economics, a brownfield investment is a type of FDI where a company invests in an existing facility to start its operations in the foreign country. In other words, a brownfield investment is the lease or purchase of a pre-existing facility in a foreign country. So, you can see the benefit of this is that you are already getting a pre-existing facility, but then there are certain cons also. So, first of all, let us understand how it operates. A brownfield investment is often undertaken when a company wants to invest and start operations in a new country, but does not want to incur the high startup costs associated with a greenfield investment. So, the company is not having that much of funds, or probably they do not want to invest so much and they do not want to open a new firm in the foreign land. So, they invest in an existing firm. The underlying rationale behind a brownfield investment is to enter into a new foreign market through businesses that already have a presence here. In a brownfield investment, the company either invests in existing facility and infrastructure through a merger and acquisition deal or leases existing facility in the foreign country. So, two ways are possible: merge or acquire an existing company or lease out the facility, lease the facility. Advantages of a brownfield investment. The first advantage is the ability to gain access to a new market swiftly, because already there is an existing company or facility and you are investing in that. So, the gestation period is also less and you can directly start the business. Lower fixed costs due to using already established facilities, infrastructure and network. So, you do not have to create all those things, they are already there. Lower staffing and training cost is also there due to the presence of already employed workers at the facility. Also, it may include existing approvals and licenses from the government or regulators, because the company which is working in that host country, that is their own company and they have already got the existing approvals and licenses they already have. Depending on if the facility is made to fit, whether modifications exist, or if the facility can be utilized without major alterations and upgrades, a brownfield investment can be very cost effective option. So, if you do not need to modify the facility, then all the more it is cost effective. But there are certain disadvantages also. Let us see what the disadvantages are. The first and foremost, the facility or infrastructure may require major upgrades which would increase the foreign investment cost. Obviously, that company might not be having the facility which you require. So, upgrading of the facility or modification is required. For that, again you have to make huge expenditure. The facility may be old and therefore require high maintenance and upkeep cost. So, there may be operational inefficiencies also if the facility cannot be adapted to new production need. There may be scalability and expansion issues relating to using already constructed facility. So, if an existing company is there with existing facilities, that might not be 100% as per the requirement of the firm which is investing in that company. Also, there are locational constraints, there may be unforeseen tax and regulatory issues that may be there. Now, again let us understand brownfield investment with the help of an imaginary example. So, company A is currently based in the United States and is looking to expand operations into India. So, due to uncertainty in the overseas market for their product, the CEO decides to conduct a brownfield investment to test the waters. So, rather than opening a new business, totally new business or establishing a new business, they are investing in existing facilities. In addition, there are numerous approvals and licenses to be acquired in India, and it has been determined that such time consuming activities can be eliminated by acquiring a local company with already approved licenses. Company A then identifies a potential target company in India. By making a brownfield investment by acquiring the target company, company A is able to expand in the market quickly. So, here they are talking about acquisition of an existing company in India by the US firm, that is company A. In addition, though through a brownfield investment, it is able to avoid significant foreign investment costs such as building its own facilities or cost of hiring and training new staff members. Let us talk about the real world examples of brownfield investment. One of them is Vodafone in India. So, Vodafone is a telecommunication company headquartered in London and Newbury, Berkshire. In 2007, the telecom firm completed the acquisition of a majority stake in Mumbai, India based Hutchison SR for $10.9 billion in cash. Through the acquisition, Vodafone was able to penetrate into the fast growing Indian telecommunication industry, which at that time was adding nearly 6 million subscribers monthly. Another example is Tata Motors in United Kingdom. Tata Motors was the largest automobile company in India during 2007 to 2008. At that time, the Indian automaker was the leader in the production of commercial vehicles. The company was the world's second and fourth largest bus and truck manufacturer respectively. So, in June 2008, Tata acquired Jaguar Land Rover's businesses in an all cash transaction valued at $2.3 billion. Through the acquisition, the Indian automaker was able to obtain intellectual property rights of Jaguar manufacturing plants, 2 design centers in United Kingdom and a world renowned network of national sales companies. So, these are the examples of brownfield investment. Let us see the difference between greenfield and brownfield investment. So, the crux of the matter is greenfield investment is investing in another country with a new company, opening up or setting a new company, while in case of brownfield investment, they are investing in an existing company in the host country, maybe through acquisition, merger or lease. So, in a greenfield investment, parent company opens a subsidiary in another country. Instead of buying an existing facility in that country, the company begins a new venture by constructing new facilities in that country. Construction projects may include more than just a production facility, as it include completion of offices, accommodation for companies, staff and management as well as distribution centers. Brownfield investments on the other hand occur when an entity purchases or leases an existing facility to begin new production. Companies may consider this approach a great time and money saver, since there is no need to go through the motions of building a brand new building. Companies may need to undergo a permitting process for greenfield investment, but can skip this step with brownfield investment, because in brownfield the permits, licenses are already acquired by an existing company in the host country. So, let us summarize the discussion on brownfield and greenfield investment. A greenfield investment refers to a type of FDI where a company establishes operations in a foreign country. Advantages of a greenfield investment are high control, economies of scale, bypassing the trade restrictions and job creation. Disadvantages of a greenfield investment are that they are high risk investment, because you are setting up an entirely new company. So, you have to invest a lot in that, in developing the facilities. also they have a high market entry cost, because licenses have to be obtained, market have to be surveyed, and a customer base have to be developed. Brownfield investment, on the other hand, is a type of FDI where a company invests in an existing facility to start its operations in the foreign country. So, they are investing in an existing company or facility of existing company. The advantages of brownfield investment are easy access to new foreign market, lower fixed costs, lower staffing and training cost, existing approvals and licenses, and also existing facilities. And this happens with the help of mergers, acquisitions, or leasing out the facility of an existing company in the foreign land. So, it is a very cost effective method, but there are disadvantages also. The disadvantages of a brownfield investment are that the facility or infrastructure may require major upgrades or is old, which would increase the foreign investment cost. Also, there may be operational inefficiencies, plus the scalability and expansion issues might be there with brownfield investment. I hope you have understood the topic of two forms of FDI, that is the greenfield and brownfield investment. For your references, these books are there, that is one by C.B. Gupta, International Business, Sumati Verma, International Business, Chaturvedi and others, International Business, Hill and Hult, International Business. So, I believe you have enjoyed this topic. Have a good read. Have a nice day. Thank you, students.